Welcome everybody to another session of the Insurance Law Workshop. Today we are fortunate to have Andrew Granato from Yale, where he's a graduate student in finance and already has a JD, and Ari Glogauer, who's a professor of law at Northwestern. And they're going to talk about the technical but very important question of the taxation of life insurance and how to reform the very unfortunate regressive and other policy disasters that seem to be lurking there. So I'm going to turn it over to you guys. Take as long as you want. Usually we go for 40 minutes, but if you want to take less or more, and then we'll turn it over to the audience for questions. Thanks again for coming, and welcome.
Yeah, thanks everyone for coming to this talk. We're very excited to share this research. Just to verify, are the slides good to go? Okay, yeah. Excellent. So this paper is titled "Reforming the Taxation of Life Insurance." Yes, it's joint work with me and Ari. And just to quickly summarize what we're going to be talking about up top. We think that American life insurance policies, which have this kind of long-standing reputation as what might be called like widows and orphans financial security, have actually increasingly morphed into financial products that function as investment funds instead, and are used very disproportionately by high net worth policyholders, rather than kind of the middle class imagined life insurance policyholder. The source of this trend, we argue, is the highly favorable tax treatment that is extended to life insurance policies, treatment that is so favorable that it is even favorable relative to the tax treatment of qualified retirement plans, like 401ks and IRAs. And so we have a variety of reform proposals that we'll discuss towards the end. Life insurance, for people who are kind of new to this market or new to this product, when most people think of the term life insurance, really what they're thinking of is like a pure insurance product, what's often called in the industry as a term life product. So that has the basic relationship that people imagine when they imagine a life insurance policy. Let's say that, Ari was a policyholder and I am a life insurance company. We make a contract where Ari is going to pay me premiums, at regular intervals. And in exchange, if Ari passes away while this policy is in force, I, as the life insurer, will make a payout to his designated beneficiaries, maybe his spouse, his kids, something like that. A world away from the life insurance product world is, for example, investment funds. These are savings vehicles. You can think of them as, for example, mutual funds or just a direct investment into, equities or bonds or something like that. So, that would be the case in which you just take your savings and you make an investment into some financial product that is going to hopefully earn a return and grow your nest egg. The difficulty in taxing life insurance is in this vast intermediate land, which is occupied by a set of policies that go under the umbrella term of cash value life insurance. Cash value life insurance, so-called because while these products retain the same basic relationship between the policyholder, the life insurance company, and the beneficiaries that a term life policy would have, they also have what is in effect a savings account inside of the life insurance policy itself. So for example, let's say, Ari and I have the contract going and he pays me the premiums for the year, and so, some of those premiums are going to go towards the actuarial cost that I am incurring by risking having to make a payout to his beneficiaries. But another part of those premiums is going to go to funding this savings account inside of the life insurance policy. That is the cash value of that policy. And that policy is then going to be invested by the life insurer into a series of, most of the time, if you buy a normal cash value life policy, fairly conservative assets, generally highly rated corporate bonds. And so there will be return on this quasi-mutual fund-like feature of the policy at the same time that there is a pure insurance policy. And so you can see that depending on the amount of cash value that a given policy has, a cash value life policy might strongly resemble a term life policy, which just has like a tiny savings element, or in extreme cases, it might pretty much resemble a mutual fund that has a slight insurance element. And so that's why we have this kind of vast middle ground of policies that kind of look like life insurance and kind of look like investment funds. And the tax treatment of these is really what we're going to argue is the issue. There's strong incentive in the Internal Revenue Code if you are a financial services provider to have your product be characterized as a life insurance policy for federal tax purposes. IRC 101 contains one of the oldest provisions of the tax code, predating qualified retirement plans, predating even Social Security, going all the way back to nearly the inception of the modern federal income tax. And it says that gross income does not include amounts received under a life insurance contract paid by the reason of the death of the insured. This means, for example, that if RE dies during the duration of the contract and a payout is made to his beneficiaries, that payout is not taxable income to those beneficiaries. Now, so that payout is included in this exemption, but what is also included in this exemption is any returns to savings that are made inside of a valid cash value life policy. In the industry, this is known as inside buildup. So, if Ari had a bunch of bonds inside this portfolio, they pay out a bunch of interest, but it was done through the life insurance policy, that is not going to be taxable income to him. Policyholder dividends, in other words, withdrawals from that cash value life policy, will also not be considered income to him up to the amount of premiums contributed. Similarly, loans against cash value savings are also not going to be considered taxable income. And lastly, moving away from the income tax setting briefly to the estate tax setting, through a properly structured trust, which is relatively standard to do for any trust and estates lawyer, the death benefit of a life insurance policy is not going to be included in the decedent's estate. And so, when you sum all of these different features together, you get this kind of, at least from the perspective of the tax code, a super product, which incurs more or less no taxation in either the income tax setting or the estate tax setting. We argue that this level of tax treatment is unprecedented, and it's unprecedented even relative to other explicitly tax-advantaged vehicles in the code. This means 401ks, IRAs, Roths of both, and forms of annuities. These vehicles, so to speak, you can either get a deduction for contributions up front or an exclusion on the other end. Cash value life policies have an exclusion. However, a lot of these policies also have annual contribution limits. You can't put an infinite amount of money into a 401k or an IRA. For a cash value life policy, there are some limits that we'll talk about in a minute. But in theory, there's no strict cash cap on the amount of money that you can put into one of these policies, and you can put in orders of magnitude more money per year than something like $7,000 or $23,000, and people do. There's also no income-based limit on usage of this type of product, and as we referenced above, the tax treatment of an early withdrawal or a loan taken out against the cash value savings element is tax-free up to invested premiums. And if any of you have ever been short of cash and wondering if you can, grab some money out of your 401k or IRA, and you've noticed what the tax penalties on those are, I think you will appreciate that in this funny sense, life insurance policy is actually more liquid from a tax perspective than any of these other savings vehicles. And so that's another big advantage as well. So we've described in great detail the advantages from the tax perspective of being a life insurance policy. What are the guardrails set up so that people do not just take anything in the world and make it look kind of like a life insurance policy in order to gain these tax benefits? There's three main restrictions on becoming a life insurance policy for tax purposes. One of them is this feature called the investor control doctrine, which used to just be a series of IRS revenue rulings, but was accepted by the tax code roughly a decade ago in a case called Weber. The investor control doctrine holds that if a life insurance policy is just a shell and the policyholder has total control over the investments that are being done with their money, then it will not be treated as a valid life insurance policy for tax purposes. This is pretty easy to get around. You have to make a lot of mistakes, as the taxpayer in Weber did, including having thousands and thousands of emails specifically directing the manager of the policy on how to direct all of these all of the savings. And so we argue that in a properly structured policy, this is quite minimal. Additionally, there is a minimal diversification requirement for a variable life policy. This more or less means that you have to invest in 5 separate investments. You can't just put it all into one security, or in some of these edge cases, you can't just put it all into your closely held business that you have moved into your life insurance policy. This is also quite minimal. The main gateway to being treated as a life insurance policy for federal income tax purposes is a highly technical provision called Section 7702. Andrew Pike's 1988 article is a seminal article breaking down how this provision works. We're going to quickly take a look at it here. I'm going to assume that everyone got a chance to read through the text here. We'll come back to it if anyone is missing a couple of commas. So that's the brief tour, and we're gonna take a slightly briefer tour through the section. 7702 requires, if you want your contract to be treated as a life insurance policy, to pass one of 2 tests. These are called the cash value accumulation test, or the guideline premium test and cash value corridor. Loosely speaking, what these tests do is that they do cap the amount of value that you can put into the cash value portion of a life insurance policy, but it's not an absolute cap. It's a cap relative to the death benefit. So if you want to put in a ton of money into your life insurance policy for savings accumulation purposes, you can put in as much as you want, as long as you scale the death benefit proportionately so that you have, so to speak, some insurance in your insurance. A particular cash value life policy, depending on certain facts about the policyholder and the insured person, could spit out, this formula, which is a fully realized actuarial simulation, will spit out different numbers of this cap. For people who are interested in going slightly deeper into the math here, what a lot of these tests do, particularly the cash value accumulation test, is that they rely on the concept of the net single premium for the policy. Loosely speaking, you could think of this as kind of a net present value for the amount of money that it would take in an upfront payment to actuarially fund the expected payout of that policy. So this will depend on the person's age, for example, and then you'll calculate, based on NAIC actuarial tables, the probability that they're going to die in any given year from here on out. And then you will take, the face value of that policy times that probability, and then discount accordingly to the present day. And so if you've made one single payment up front, it would, in expectation, fund the rest of the policy.
Andrew, can I just ask a quick question about the previous slide? So there's cap relates to how much the death benefit is. But if this is such an advantageous investment vehicle, then presumably you just want it. That's not much of a constraint because you just want to put as much in the death benefit. You're not tying up funds in any way. You're just earning tax reduced or tax-free interest on it. So is this in effect no constraint at all? You just make your policy bigger and then you can do all the kind of stuff you want to do? Or is there some other, am I missing something about that?
Yeah, so essentially what the trade that you're being pushed into is more or less you can put in as much money as you want to get this like savings element that's going to be tax free, but the more money you put into that, the more in dollar values in life insurance you're also going to have to pay for in increased premiums. So what you would want to do ideally is you would want to get rid of the life insurance element of the life insurance policy as much as possible, because the less life insurance coverage you have, the less money you have to pay in premiums every time. So if you also want to buy like an actual life insurance policy, then you're in the best of all possible worlds because you'll buy your life insurance policy, and then in the same financial product, you'll also get the tax exempt savings vehicle. But if you don't actually want to buy any life insurance coverage, so to speak, and you just want the tax exempt savings vehicle, you'll like as a price for doing so have to also pay premiums every year for that coverage. And then lastly, one last note on the net single premium calculation. Every single part of this formula is contestable. For example, the NAIC tables requirement was added because it was found that in the 1980s, before the requirement to use specific tables was created, life insurers were using suspect actuarial tables to try to game this calculation. Similarly, my prior work has focused on how you can game the interest rate that is being used to calculate this number, with the idea that if you can decrease that interest rate that's being used in the formula, you can mechanically increase the net single premium for a given policy and therefore increase the amount of savings that you're allowed to put into a given cash value policy. But we'll bracket this for the rest of the presentation. But I just want to put on the table that the way that 7702 works, in part because it is so complex, I've never really seen something else like this in the tax code where you put in a fully realized actuarial simulation that like requires you functionally to be an actuary to like truly follow what's going on. It's very difficult for policyholders to follow what's happening here, and I think in any meaningful way. So stepping back, we've said, if you're a life insurance company, you want to have your policies be considered life insurance for federal tax purposes. This policy of total non-taxation, originally came about because of this idea that it seems cruel to tax widows and orphans. And now we'll ask, who's really benefiting from this tax preference? The people benefiting from this tax preference increasingly are people in the highest wealth deciles. So these charts we just grab from the Survey of Consumer Finances, which is the gold standard household wealth survey. And we ask, conditional on owning a cash value life policy, what is the mean face value of that policy? And then we chart it over time for different wealth deciles. Overall, cash value life usage has actually been dropping in the United States over time, with the exception of very high wealth policyholders who are putting in increasing amounts of money into the policies that they have. So now we're getting into, a mean face value, which is like you can think of as the death benefit of like $3 million per policy. On the right side, we look at the mean cash value reserve amount, which is like the actual sort of money that's inside. And you can see that it's also growing strongly there as well. Another way to map this dynamic is provided to us quite kindly by the Federal Reserve. Apologies for the way that the graph is showing up there. The timeline is basically 1990 to 2024. the Fed puts out a graph where they estimate the share of life insurance reserves in the entire life insurance industry that is held by families that are in the 99th wealth percentile. This is a figure that was about 10% in the early 1990s and is nearing 30% now, so it's nearly tripled. And what this illustrates to us is that the life insurance industry has this historic tax advantage that was granted to it in very different circumstances. But the main beneficiaries of this tax advantage now are increasingly people who have a very, very high amount of wealth already. The tip of the spear in terms of the way that the life insurance industry has been reacting to this dynamic is a product called private placement life insurance. People get very excited about PPLI. What PPLI is it's a subtype of variable universal life insurance. So a universal life insurance policy is a policy where you can adjust the death benefit midstream, and a variable life insurance policy is a policy where the returns you get on the underlying assets of the policy will also be the returns that the policyholder gets. So a whole life policy, they might just say like, oh, you're going to get a 4% return or whatever. A variable life policy, you'll just get the return of those underlying assets. So a private placement life insurance policy is this very flexible product that looks less and less like a classical term life policy. And as the term implies, it's called a private placement because under the securities laws, it is formally a private placement. Variable life policies are must be registered as securities, but private placement policies are not registered as securities. And the reason that they are not is because they take advantage of the Reg D exemption, and they have to be sold to people who meet the SEC's definition of an accredited investor. More commonly, they are sold to people who meet the SEC's definition of a qualified purchaser, which basically means an extremely wealthy person. And these sorts of policies are really the kind of high-end boutique life insurance policies. As an example, we went around looking for how these products are sold. Here's one example among many. Cone Financial Group tells you directly, PPLI is designed as a tax-efficient instrument with the death benefit being secondary. So they're just saying the quiet part out loud. This is not when I first saw this screen, I screen capped immediately, and it was like, I can't believe they would just put this out on the internet. And by now I've seen like 12 different versions of this. So this is not at all an outlier. We now, for the first time, because of a Senate Finance Committee investigation led by Senator Ron Wyden, we have a little bit of data on PPLI policies. So they issued subpoenas to the top 7 domestic PPLI providers. They find that there's a face amount of about $40 billion of PPLI issued by these 7 providers. And the average face amount of a PPLI policy is about $13 million. So to illustrate, when we had that SCF graph, we were finding that among top 1% households, the average face value of policies that they were buying was about $3 million. So this suggests to us that there's maybe, despite the best efforts of the SCF, sort of underreporting of these sorts of things. And we think also that the operative word in this sentence is domestic. We have next to no visibility into the offshore PPLI market, particularly the Bermuda PPLI market, which anecdotally is extremely active. This is a matter of a lot of concern. We don't even have a way to give you an order of magnitude estimate of how much money is in PPLI policies that are offshore. But this is the only data that we have, and so this is just sort of what we think of is the tip of the iceberg for this premium investment product that gets all of the tax advantages that we discussed before. We argue in this paper, as many have before, against life insurance tax exceptionalism. It has increasingly become an upside-down subsidy for the wealthy, particularly with the continued growth of PPLI. It is a subsidy to the life insurance industry, for example, which has increasingly just started selling its tax advantage as the product itself, more or less. We think that the complexity of these tax rules, particularly in 7702, invites abuse. And we think that the kind of black hole of life insurance in the tax code obstructs fundamental reform in other ways. Daniel Hummel first pointed out that in the event that stepped up basis is fixed, life insurance will likely step into that gap. So for people who are outside of the tax world, the basis of an asset is kind of what your capital gain is measured by. So if I bought Google stock at 1,000 and then I sold it at 1,500, because I bought it at $1,000, I would have $500 in taxable capital gain. There's a rule in the tax code that says that if an asset is, bequeathed to someone through, kind of through death, so this is a gift that is made at the time of death, the basis of that asset will reset to the fair market value of the asset at the time of death. So if that Google stock was given to me by someone as they were dying, my basis in that stock would not be $1,000, but it would be 1,500. And so if I were to then sell that stock at the time that the fair market value is 1,500, my capital gain would be $0. Life insurance is not an asset that is passed down directly through death. It is a cash payout that is made by a third-party entity at the time of death. So if you fix, quote unquote, fix stepped up basis, one possible outcome of that is that there's going to be a stampede of money into life insurance products because there's going to be no taxation on them, while the benefactor is alive, and then upon death, they'll just get the cash payout rather than receiving a transfer of assets that will no longer receive stepped up basis. We propose a menu of reform options in this area. There are various more modest options that could be done by actors in the system other than Congress. But even modest ones, unfortunately, will often require congressional intervention. You could try to tighten the savings account ratio formulas in 7702. In other words, require people to buy more life insurance when they buy life insurance. You could tighten the diversification requirements, which would help probably fix some of the more abusive cases that we've seen. A classic abuse of the life insurance form will it be, someone owns this privately held business, they don't want to pay tax on the business, they create a life insurance policy that is nominally independent. That life insurance policy, buys shares of that business, and voila, now you no longer have to pay taxes on your shares in the business. This would run afoul of investor control requirements. But again, that's a fact-intensive determination that is fought on this individual level in the tax court, and so that could be tightened as well. We also think that you could reform a provision called 1035. The tax people in the audience will likely be familiar with a tax code provision called 1031, which is a big deal in the real estate world. It allows for non-recognition for capital gain purposes of a lot of real estate transactions, where you have one kind of real estate property, and then you instead transfer ownership over to another one, but you don't incur a capital gain. This is called non-recognition. Life insurance has its own 1031 called 1035, and this has been used notably. There's a tax note series that we've been reading with great interest on life insurance policies. One enterprising taxpayer had the idea that they would have a offshore life insurance policy, so one that is essentially invisible to tax authorities, where they would transfer their closely held business. But then what they would do is that they would just 1035 that offshore life insurance policy into an onshore legit so to speak, life insurance policy. This is pretty easy to do under current law, and so we think that 1035 could be made more restrictive as well. When we think about maybe more fundamental reforms that are more principled, the historically preferred option proposed, including by the Ronald Reagan administration, which fought pretty hard for this, is to tax what's called the inside buildup on these policies, which makes sense. If you have a product that is part, life insurance policy and part, quasi mutual fund, you could try to disaggregate these two functions and say, well, the quasi mutual fund part of this is earning returns, and those should be taxed. Another option would be to at least try to make the tax treatment of these financial products not more favorable than the tax treatment that is received in 401ks and IRAs. So that would involve flipping the accounting rules on withdrawals and loans against the cash value. This is already present for a subset of life insurance contracts called modified endowment contracts. And so you could write a law that just extends modified endowment treatment contract to all life insurance policies. Lastly, the sheer persistence of the life insurance special treatment in the code is quite impressive in a sense that it's been able to go on for so long. The industry has a lot of friends in Congress, and so we talk in detail about potential ways that a more targeted approach could be done to try to carve out maybe the most egregious examples of life insurance special treatment while leaving the rest of it intact. You could limit the benefits based on a policy type. For example, you could carve out PPLI products specifically, or even more specifically, offshore PPLI products. This is the approach that Senator Wyden takes in his recently proposed Protecting Proper Life Insurance from Abuse Act. You could limit the benefits of these policies based on the characteristics of the underlying taxpayer. This is the approach that Senator Wyden takes in the Billionaires Income Tax Act, which is the first proposal, as far as we know of, that specifically mentions PPLI and indicates that Congress, has its eye on these products. Or lastly, you could limit the benefits based on policy size. So you could say, oh, if a policy has a certain amount of face value or a certain amount in cash value, then it will, have its benefits limited. And aggregation rules would then have to be implemented in order to make sure that, someone couldn't just buy several different life insurance policies, each of which would be under the cap. And so in the paper, we go into a lot more detail about the specifics about, the way that each part of this menu could work in practice. So to conclude, we argue that the non-taxation of American life insurance policies has created this large and growing channel for tax avoidance, particularly high-end tax avoidance. Part of the reason this has happened is in a sense that there's new competition in the market for tax-preferred investments. For the median, middle-class family or maybe an upper middle-class family, now that 401ks and IRAs exist, they're just putting their savings into those, which means that the actual people who are benefiting the most from the cash value life exemption are the people for whom they blow over the limits of what you can put into a 401k or an IRA. This law has not been updated to reflect that reality, as well as the reality that the American life insurance industry is in the midst of a pivot away from being in the family security business to being a premium tier investment service. And we argue that there's a variety of reform options that could be undertaken. And, we try to make the case that various caps can be designed that would target these platinum policies and policyholders, but retain the preference for the rest of the life insurance policy market. Hopefully, in a way that could make this more appealing to policymakers. So thank you very much.
Great, thank you. That was amazing to cover all that technical stuff in such a clear and lucid way. I have a bunch of questions, but I would love to take questions from the floor. You can chat them to me or you can raise your hand. I'm not, yeah, so maybe start with what seems like maybe this is just maybe a nitpicky kind of thing, but on page 254 of your paper, it seems like there's an interesting difference between the extensive margin and the intensive margin for the top 1%. That is, it looks like they're buying a smaller share of the top 1% is holding these products, but among those who do, they are increasing the amount that they hold. So I guess my question is, like, why would that be true? Is there something about the decision among these uber rich people to get one of these policies that has changed so that it's less attractive to some people but much more attractive to other people? Or is there anything you can say about that?
Yes. So this is something that's been, very interesting. In the last few decades, the overall presence of life insurance has declined. The number of people buying term life policies as a percentage of the American public has gone down, and the percentage of the American public that is buying cash value life insurance has gone down. However, if you look at the assets under management of the life insurance industry, every year it continues to hit new highs. And the reason why that is possible is for two reasons. One is prosaic, is just population growth in the US. And two is that the people who are buying life insurance are buying a lot more of it. And that we think is this dynamic where, top 1% households are buying, if they choose to buy a life insurance policy, they're buying it not because they want to have this little bit of a safety net, but because they're buying a ton of it to use as an investment vehicle. The reason why life insurance in general has had a declining market presence is a bit complicated. But the main reason that people point to in the academic literature is because of the low interest rate era. Most life insurance policies are supported by corporate bonds, and the portfolios of most normal life insurance companies in general on their asset side are also corporate bonds or asset-backed securities. So if the treasury rate goes down, as it did, after the peak in the 1980s, and was really near zero for nearly a decade, that makes life insurance, or at least a normal life insurance policy, relatively unattractive when you could invest in equities instead.
Yeah, and I'll just add on this point about the intensive versus extensive margins. Another thing that Andrew and I are really interested in that we didn't really have a chance to dive into in this paper is, whether we're seeing a divergence or a segmentation of the market for different types of tax preferred products.
So, yeah, so it's like within the 1%, it's the very, very, very richest of the 1% who are doing this, or something like that. Is that your story, basically, that those people find this most advantageous, and just the ordinary super rich can do other things or can't take advantage of this in the same way?
Yeah, or potentially the opposite. There's a limit to how much that's insurable, so maybe it's not a great strategy at the very top of the income distribution.
Yeah.
Go ahead.
And anecdotally, when we look at what people from the industry have said, the kind of typical client for a PPLI policy that they look for is someone who seems to be in the wealth range of something like maybe 10 to 100 million. And that's because, at the very, very top, it just becomes almost too risky to try to insure someone. Rather hilariously, there is a Guinness Book of World Records record for the largest life insurance policy sold. If I were a billionaire, I personally would not risk telling the Guinness Book of World Records about my financial transactions like this. But I believe the current record is about $250 million.
All right. I had Walter Welsh, who is an industry.
Hello, how are you? Thank you for all your work on this. And just reading the paper for me was a tour back from a long time ago because I was working for a company when 7702 was put in and 7702B were put in, and it was our actuary. I only can do those code sections when I have an actuary next to me. I don't actually, lawyers trying to read this stuff is sometimes quite hard. But what's pointing out that when you think of that time, tax rates were very high relative to where they are today, post the 1986 tax changes in the 2017. So some of the advantages of the inside buildup are not there, but certainly for the high net worth, as you pointed out quite well in your paper, and private placement life insurance didn't even exist in 1980 or 1982 or 1984 when these changes were put in place. What happened, and it's just a background point, and you already probably know this from all you've read, is that life insurance, there was no universal life until about 1981 or 1982, and you could not, with that, you could not really see what was going on inside the life policy. But when the introduction of universal life clearly separated the investment portion from the mortality portion, and companies were concerned who did not write universal life policies that this would put a focus on the tax advantages, and they might lose those tax advantages. And so the net result of that was that companies worked hard to actually develop some kind of restrictions, the ones you just described, that may not go far enough. But that's the what happened. My point is just really a background point, and there's a lot that could be done to improve 7702 or 7702 Cap A, or you could do the limits you just described. But thank you for putting this together. I try and cover a little bit of this in my class on life insurance, but I don't want to cover too much detail because it's hard for all of us.
Yeah, thank you. Your point reminds me actually of something that I forgot to mention in the presentation, which is actually one of the key points of PPLI is that by having your life insurance policy itself be a private placement, it means that the investments that can be made with that life insurance policy can also be private market assets. So if you have a normal life insurance, cash value life insurance policy, typically the investments that you're going to be, investing in through that policy are going to be mutual funds of publicly traded debt and publicly traded securities. And that's because, as the underlying policyholder does not meet the SEC's definition of an accredited investor or qualified purchaser, you're not eligible to buy private market assets. But if you, the policyholder, are an accredited investor or qualified purchaser, that means the asset classes that get opened up to you are basically, hedge funds, private equity funds, venture capital funds. In other words, very high risk, high reward industries that if you were to say a normal person like, oh yeah, I have like some investments in my life insurance policy, this thing that's supposed to be very safe to pay out to my spouse and kids in the event that I die too soon. What are those investments in this like safe policy? Oh, I am in hedge funds. I am in PE funds. I'm in VC funds. It just opens up this whole other world. And in particular, it opens up this whole other world because some of those same industries are notoriously tax inefficient. So if you have a quant trading hedge fund, for example, because you are not buying and holding a lot of those assets for a year, a lot of those gains are going to be at the short-term tax rate. So you don't get the long-term capital tax rate. And so this is a huge problem for a lot of hedge fund investors. And so they're particularly interested in trying to, get out of the taxes on these things. And PPLI is just an amazing vehicle, really, for getting out of every form of taxation you could possibly want.
Yeah, I just have one more comment. I think that is really, PPLI is a whole new change in the last few years when people look at life insurance. With regard to the maybe less people buying whole life warrant at the high end, the ability to buy term insurance for a 5-year, 20-year term period is much different than what existed, say, 10 or 15 years ago. So people used the cash value that was in a life insurance policy to keep the premium level over that period of time. But today you can buy a life insurance term policy with a fixed premium for maybe 10 years or even 20 years. So that's changed sort of the interest in cash value life insurance for, say, the middle or lower income folks. Thanks.
Right, I had Olivia Capel.
Hi, I just had a quick question to clarify about your proposed reform for taxing inside buildup. And I know typically per the Internal Revenue Code, tax on capital gains doesn't occur until the gain is realized, meaning either upon sale or withdrawal. So would be the proposal be simply to take away that tax advantaged exclusion that currently exists, or to push the envelope further and actually try and tax the gain, those returns as they accrue, to sort of disincentivize using life insurance policies as a tax advantaged vehicle?
Yeah, this is very interesting. So right now, the way that the tax code treats this, formally in 7702G, is that if you fail if your life insurance policy fails the IRC definition of being a life insurance policy, you get taxed on gain that happens in the cash value portion of your policy, functionally as a pass-through. So the way that they define it is, so you get taxed on your like income on the contract, which is the sum of the increase in value in your cash value portion, plus the actuarial payment that you made, minus the total premium that you made. So what that ends up being is, if you have investment accrual inside of your policy, that's what gets taxed, and that gets taxed like as it happens. So you don't have to make a withdrawal from that policy in order to receive kind of current taxation on it. So it's functionally a pass through. And so I think a lot of the policy proposals that we put forth or that argue for involve essentially extensions of the 7702G regime. And it would tax it on a pass through basis. But I think also what you're getting at is that, in some sense, life insurance is very difficult conceptually for the tax code to manage, because you're operating at this kind of like double level of distance. And so it's kind of, in a sense, like almost anything you could do feels a little bit unintuitive. And so the way that the tax code has responded to this is that it's made several choices that are like kind of arbitrary, but they're all arbitrary in the sense in the pro-taxpayer direction. So they're all the maximally pro-taxpayer approach. And so having a purely principled life insurance policy taxation, I think, as you're getting at, is a bit difficult to even try to do.
Yeah, and I'll just add, I think it is interesting that there are different flavors of what a look-through taxation of the inside built up how it could be structured. If you look at 7702G, the income on the contract paradigm, as Andrew said, it does seem like it's an accrual concept that doesn't necessarily key off of realization events for tax purposes in the underlying assets. On the other hand, if you look at the updated Senator Wyden proposal that was released in December, as I understand it, that's more like a look-through tax concept where you're just treated as holding the underlying assets in the policy directly, but then presumably you wouldn't be taxed until there's a realization event for tax purposes. So it is interesting to think about the different ways you could structure it.
Yeah, one way, for example, would be to say, like, you only get the taxation of that will occur at death. And so any value at death that is transferred to the beneficiary that is attributable to inside buildup will be treated as taxable income. And so in this sense, the taxpayer will still receive gargantuan deferral benefits, but there'll be gargantuan deferral benefits commensurate with the current treatment of these other kinds of assets.
Thank you.
Okay, anybody else? I have a bunch of other stuff I'd love to ask you about. Maybe this, again, is sort of beside the point, but So there's this big tax savings to be had from these products. And I guess my question is, how much of those get captured by the individual life insurance holder, and how much are captured by the people who are selling the product to them, the insurers? I guess if it's a competitive industry, you'd think, okay, they're going to earn zero profits, so all the commissions and whatever will be down to basically the cost, and so all that gets transferred to the life insurance owner / investor. But is that your sense, that mostly what's going on here is that all the benefits are going to the rich guys who buy it, or how much is being siphoned off by the people who supply it?
Yeah, very interesting. So there is a lot of discussion in the life insurance space about non-PPLI policies, just about normal policies, that so normal life insurance policies are sold on commission by insurance salesmen. And the commission that these salesmen can get is often like pretty substantial. And so for that reason, if you go into kind of like, personal finance Reddit or like personal finance communities, for that reason, cash value life insurance, despite the excellent tax benefits, is not really considered to be kind of like a tier one, like everybody should do this kind of thing, because the tax savings are considered to be like offset to a great degree by these commissions. However, PPLI policies, at least in the marketing documents that we've seen, in part market themselves explicitly based on the fact that there are no salesmen operating here, and so there's no salesman taking a commission. And so they argue that PPLI policies are dollar for dollar cheaper than non-PPLI cash value policies. So at the same time that you are kind of getting rid of the securities law restrictions on the underlying assets that you can hold in the policy, you are also, at least if you believe the narrative that PPLI providers are putting out, you're actually getting the policy itself more cheaply. And, I think to some extent that could be offset because the lawyers involved and the wealth managers in PPLI policy are taking a greater percentage of that amount. But we unfortunately are not really able to observe that, just because the market is so opaque. And really the only data we have on PPLI at all comes from this like one Senate Finance Committee investigation that provided a couple of top line summary stats.
And just as a follow-up, as a policy matter, like, it seems a little like reversed to say, well, we need consumer protection for the buyers of these things to make sure they're not being ripped off. Like, I don't know, everybody's got sort of unclean hands at some level, not. So if your business model is ripping off very, very rich people by charging them high commissions on these products that help them evade taxes, like, how should we be happy that the rich people are getting a lot of their tax savings sucked into less rich people, or like how should we think about that?
I think all we can say is that, like, from the revealed preferences of rich people, the rich people think that whatever they are paying in commissions, it's more than offset by the tax benefits. To what extent this is the case is kind of unknowable, but it clearly is the case that they are finding a lot of value in this, and increasingly so over the years.
Okay, who else? This was a technical paper, even though it was incredibly lucid, and you could really figure things out if you read it carefully, but I can understand why people are somewhat timid about asking questions. Anybody? You guys have any further comments you want to make before we close out? There's only 3 or 4 minutes left anyway. You guys, Andrew or you want to have the last word?
I just this has been really fun, and yeah, there's a lot to talk about, but I'm so grateful for you for hosting us and chatting about this really fun intersection of insurance law and tax law.
Yep. Well, we're very delighted to have you. I guess maybe one last thing and maybe this is too depressing a note to end on, but like, what do you think the prospects for reform actually are? Like, so Wyden seems to be taking this seriously, but how much, Is anybody on the other side taking this seriously? Is there any chance that there's a deal in the works that could change this?
We think that that probability is low. Although we want to say like never say never, because a couple years ago, no one in Congress was paying attention to this, and Senator Wyden has really made this a focus of the Senate Finance Committee, and so it's sort of back on Congress's agenda in a way that it hasn't been since the 1980s great debate over 7702.
Yeah.
Walter, I'll let you have the last word.
Just one more comment. I think as you look at this, I know you folks are looking at the benefits for the high end out of this. When you look at what happened after the 2017 Tax Act with a 20% tax on dividends and capital gains, we could spend a lot more time thinking about that than what we're going to do with life insurance. It would be a lot more important, I think, to work on that.
Yeah, I think the way that we think of life insurance is that life insurance taxation in it of itself is an issue of perhaps like moderate importance in terms of the ranking of how important things are in the tax code. However, if you want to do a true systematic reform of the tax code, there like has to be a provision in that bill somewhere that like addresses life insurance. Because if you leave life insurance alone while pursuing a systematic reform, then the tax wedge that like benefits like life insurance policies will just grow and grow so substantially that it will become a black hole through which you can fit everything. Just because the design of the product is also kind of so weird and and so foreign to the way that the tax law usually works.
Yeah, that makes sense. Thank you very much again.
All right, let me join Walter in saying thank you. Come back again. Maybe in 5 years, we'll have some new and better laws that you can talk about, and hopefully that will be the case. Oh, wait, Peter Jones. All right, you want to come in with one last one?
So I think you're muted.
No, I'm sorry. I was trying to applause. I hit the wrong thing. But thank you so much. I really appreciate it. That was fascinating.
All right, guys.
Thank you all.
Bye, everybody. Thank you for coming. See you in 2 weeks.
Thank you.
Bye.